Hi there, my name is Steve Nabisky. I'm the editor and publisher of GMTA Market Letter, Global Macro Technical Analysis Market Letter. Today we're going to take a look at gold basis the COMEX August 2014 future. This is a monthly chart, so each bar on the chart, the green bars, represents 1 month's trading. This particular chart dates back to April of '99. The secular bear market, which got underway from kind of the mid 1980 area, ended up bottoming here in August of '99. That particular low came in at 253.8 from August of '99. You can see we essentially went sideways, a bit of basing action here, a little bit higher in December '01. We started to see an uptrend develop. It started to accelerate in July of '05 and then eventually went into a bit of a parabolic rise right up into September of '11. That high in September of '11 came in at 1,923.7 on this contract. The return from August of '99 to September '11 represented then almost 658%, not too shoddy. Anyways, what we want to look at and kind of emphasize right now is what we think has been happening from this September 11 high, and it's our opinion that this has been a corrective period. We've been seeing a large downtrend channel or macro flag develop from that September 2011 high. At this particular stage, you can see that we came off the high. We then went into a bit of a consolidation pattern here. We went to A, sort of B and C up, corrective action. We then drop back out of this pattern down into, and now it looks like we're in another little continuation pattern. Again, A, B, C. We think it may have completed here already, taking the form of a triangle. And again, because of the direction into the pattern, we would expect the same coming out of it, and we would tend to look for a low down into this area down in here. The projection actually out of that triangle is down to approximately $928. Now that might just break the bottom of this flag a little bit, but from our perspective, if we don't start seeing too lengthy a time below that flag, in other words, if it just presses down, it kind of flushes out a bit and then rises back up, we would then anticipate that the macro flag pattern is still dominant, and that we would then see the uptrend, overall uptrend from December '01 resume in this large macro uptrend channel we've drawn here. So we've tried to highlight what we think is going on over here. You can see the large arrow coming in, the first consolidation period developing in here, and then they drop down into this triangle formation here. We then do our little corrective action. We think we're here right now, and we anticipate ultimately that we might see these lower prices develop before we then resume to break out of the macro flag in the same direction that we came into it. Now we can't rule out that this pattern may not morph into a flatter consolidation channel, or it could even go into a reverse triangle or a megaphone pattern. But from our perspective, really, it just gives more opportunity perhaps to lighten up a little bit. We don't think this is a time to be over levered in this market at this juncture, with the prospect of lower prices still developing. We can't guarantee it, and perhaps we just see some bottoming action developing. She doesn't break fully out of the triangle, but until such time as we see certain things develop, like for example, what we want to do is see these momentum measures down here. Now these are longer period oscillators, and what we're primarily concerned about with these are the crossover periods here. Okay, so you can see a crossover down near the high point, and this wouldn't be exact but would tend to come in a bit afterwards. We can see the trending start to take place as we come down here. Now we can see we've hooked up and started to bottom. We haven't crossed back up. There's still some spread between these two measures. They are very long-term measures. They represent 10 and 30 months, 20 and 60 months. So this is not short-term work and should not be treated as such. And it should be kept in mind. This is really for your position traders, for looking at kind of the long-term return picture. We anticipate here that we could even see, if a new price low develops down into this bottom level of the macro triangle, that we would probably hang up a little bit higher here on this red shorter period 1030 oscillator and create what we call a positive divergence, where the momentum wouldn't confirm the lower price low. That would be our signal, frankly, for a lower risk buying opportunity if it does transpire that way. The other thing we want to point out is to look at this stochastic. It's a more sensitive one. It's a 21 bar or 21 month period, so it tends to be a little bit earlier, a little bit faster. It's still in a down cross position, but it has started to travel sideways. Now we expect we could still see a little further weakness here, and then a cross back up, and that would reflect the the push down to the bottom of the macro flag before we then reverse out. This is not a time in our estimation to be over levered in this market. I mean, we think that core positions have to be maintained. We think that you can add to sound positions on good pullbacks here. In particular, if you see a breakdown out of the triangle, then that would be the time to start to add back a little bit more aggressively, in our opinion. But we think this market still has quite a bit higher to go, and if we can get down to that 900 level and then see a move back up to the 2200, 2300 area, that would be well worth the wait and well worth any short-term pain that might be experienced in between. So maintain core positions, trim on strength if it develops short run in here, add on breaks into and below the the lower levels of that pattern and below the pattern itself. So anyways, that's the way we see it, and this is Steve Nambisky again for GMTA Market Letter, and thanks for joining us today. We'll talk again soon. Thank you.